Hello, my name is Kurt Anderson. I'm the partner in charge of tax with the accounting firm of Corbett, Duncan, and Hubley. Going to be addressing some of the issues for Illinois manufacturers or manufacturers in general that look to go global with their products and some of the issues that they may be facing. Today we're going to focus on three major issues: tax breaks, and which would be the interest charged domestic international sales corporations, or IC-DISCs. We will be looking at the research and development tax credit, and then we're going to be discussing transfer pricing as well. The first item is the IC-DISC, or interest charged domestic sales corporation, domestic international sales corporation, pardon me. And it's a special purpose entity that is set up by a company that is selling its goods overseas. If you have international sales, there's an ability to generate regular, ordinary income tax deductions and pick it up on income, on the income side, as a qualified dividend, which if you understand the play there, there's actually a 19% spread. So the tax savings is really an arbitrage, and we'll walk through in more detail the interest charged IC-DISC. Who qualifies? Exporters of U.S.-made content. 50% or more of that content of the product has to be U.S. sourced. It's also available for engineering firms and architectural firms providing services for foreign operations and foreign construction projects. Specifically, what is an IC-DISC? An IC-DISC is a special corporation, very simple to set up, minimal capital. The statute requires that it be set up and funded with at least $2,500 of capital. The entity itself, the IC-DISC, is tax exempt. It does file a tax return, but provided it is paying out dividends, as it's required to do, on a timely basis, there is no income tax at the entity level. And what does this corporation do, you might ask? It effectively collects a commission for sales of the goods. It collects a commission from the manufacturer on the outbound product. And that commission is the only income that the IC-DISC will earn. And how does it work? Well, again, I had mentioned it's the tax spread. If you're working with an S corporation or an LLC or a partnership where the income is passed through, that income is taxed generally at the highest marginal tax bracket, which for the individual is 39.6%. However, qualified dividends received by those same individuals are taxed at 20% for 2013, 2014 at this time. So what happens is, let's assume we have an S corporation manufacturing a product in the United States and selling into the Caribbean. That S corporation pays a commission to the IC-DISC that's owned by the S Corp's shareholders. So now the corporation takes a deduction at 39.6% on the income, pays it to the IC-DISC. The IC-DISC then turns around and pays a dividend of its profits out to those same shareholders of the S corporation. Those dividends are now taxed at the shareholders, on the shareholders' tax return, at 20%. Again, these numbers are excluding state income tax. But again, it's a 19.6, effectively a 20% tax savings on that spread. There's a couple of other things to be aware of. There are some caps on the amount of commission that can be paid to the IC-DISC. And the caps are either 4% of international sales, plus some reimbursable expenses, or 50% of the net profit of the international sales. So what I've put together is just a quick summary, and we can walk through it here. We're going to use Acme as the manufacturer. Acme has foreign trading gross receipts of $15 million. Cost of goods sold of $8 million, a gross margin of $7 million, other deductions of $1.5 million, giving a foreign sales taxable income before commission of about $5.5 million. If they were to do the IC disc arrangement, they could potentially pay the IC disc the greater of two numbers, either 4% of the $15 million of foreign trading gross receipts, which would be $600,000, or 50% of the profits on those foreign trades, which would be $2,750,000. If we use the 2.7, assuming we're paying the maximum amount out, let's walk through the final part of this sheet shows the actual tax implications. Acme had taxable income, assuming no IC disc, of $5.5 million, which means if it's a pass-through entity, the shareholders have a tax liability of $1,925,000. If Acme uses the IC disc and maximizes its benefits, the shareholders will have a tax liability on the income flowing from Acme of $962,500, and the tax that they have to pay on the dividends received from the IC disc of $550,000 for a total tax obligation of $1,512,500. It generates a tax savings of $412,500 right off the top. So it's a great way to start financing those international operations, expanding it and taking advantage of what the Internal Revenue Code provides as an incentive to compete internationally with those companies that may be manufacturing same or similar products. It's a wonderful opportunity. There's a couple of other ways that the IC disc as a benefit can be supercharged. You can structure it as opposed to having individuals own it, you can structure it so that tax-deferred accounts, whether it's an IRA, Roth or traditional IRAs, can actually own this IC disc stock. There would be a little bit of a tax at the entity, the IRA level, but again, it's de minimis, and then all of the dividends would escape income tax at the entity level and would continue to grow in those IRA accounts. There's some wonderful opportunities to use the IC disc to really leverage the international growth of U.S. manufacturers. The next topic would be the Research and Development Tax Credit, or R&D credit. What is the R&D credit? It's applied for product development, process improvement, tangible property development, including pilot programs and products and activities that are capitalized traditionally, and then soft costs and hard costs for goods that can be sold are now considered part of the R&D. And so some people think that the R&D credit is really just for the Abbotts or the Baxters of the world that are developing drugs. That's not the case. It can be as simple as an injection molding facility that needs to figure out how to get a cavity in the injection molding process filling properly, or so that there's proper flexibility within the materials. The time that you're spending to develop and enhance a product or improve a product are expenses that are eligible for the R&D tax credit. If you're developing a new product, clearly that would qualify for the R&D credit. If you're preparing some software to develop a new line, that's available as well. It's some of the things you don't think about. If you're going to take a product to Europe, maybe you have different requirements, whether it's the electrical processing on the product or otherwise. All of the activities involved in developing that product, researching it and or developing that product, those expenditures are available for the R&D credit. There are some things that do not qualify for the R&D credit. Ordinary quality testing or inspection, those expenses don't qualify for R&D. Efficiency surveys, management studies, consumer surveys, advertising and promotions or acquisitions of others' products, models, production processes. These are all items that don't qualify. These are all expenditures that don't qualify for the R&D credit. But if you can track and follow the items and the types of expenses that you're incurring for the R&D credit, there's a wonderful opportunity to take a tax credit. And the tax credit itself is, on the thumbnail, is approximately 6.5% of those expenditures. There, you can actually claim a higher credit, and there's a trade-off that goes in depending on how you're calculating the credit. If you want to continue to deduct the expenses, you're going to use a simplified method, which would result in the 6.5% tax credit. But again, those expenses now would be allowable on state returns that may not allow you to claim an R&D credit. On the other hand, if you take the higher credit, you won't be able to deduct those expenses. So there's a balancing act that you have to undertake, and an accountant familiar with the R&D credit should be able to help you with that. The other thing you should be aware of with the R&D credit is recently the IRS, as part of their audit policies and procedures, have a requirement that your records for claiming the R&D credit need to be kept contemporaneously with the activity. So if you're modifying a mold to make it work properly for a particular item, or any of those types of things, as you're doing it, you need to identify the project that you're undertaking, and in all reality, the majority of the expense is generally time, and that would be wages of those performing those services. So if you're having your engineer, your plant manager, any of those folks that are doing work that would qualify for the R&D, if you track their time contemporaneously with that, that would be sufficient support for claiming those credits. Obviously expenses, supplies, materials, all those types of things that are rolled into the testing and the development project, those are all qualified expenses, and again, you should be able to track those fairly simply and straightforward to calculate what your expenditures are on the R&D credit. Again, if you're looking to take products overseas, great opportunity. You're going to end up redesigning some of the products to make it more appropriate for the culture and or the country in which it's going to be sold. So if as you look to go global, make sure you're taking advantage of the R&D credit. And then the final thing we're going to talk about today, for those companies that are looking to take their business offshore or conduct business overseas, is what's referred to as transfer pricing or transfer pricing studies. As most people have heard, some countries, are high tax countries, the United States being one of the highest tax countries, and others are very, very low, whether you go to some of the Caribbean islands, South America, some of the other countries have fairly low taxes, and everyone hears of the companies sheltering their profits offshore. Well, one of the things, or one of the tools that the IRS uses to reduce that, the likelihood of people parking profits offshore, is what's referred to as transfer pricing. And transfer pricing needs to be addressed when there are related parties providing services or goods across border. So you're a Chicago manufacturer and you set up a plant in Mexico. You set up a separately wholly owned company in Mexico, and you're doing production in Mexico, but you're managing from the United States. How do those companies intercompany charges occur between Mexico and the United States? The IRS's position, and most countries' positions, are that those charges need to be done on an arm's length basis. That's tough to do when you have related parties. So what they've said is, we want you to do an economic study of the costs of the services and or goods being provided between related parties. These studies that they're requiring you to undertake are referred to as transfer pricing studies. Some people think that that's a lot of excess work that they really shouldn't incur. My comment would be that if you have that international activity and you fail to obtain a transfer pricing study for those related party transfers, whether it's a management fee going from Mexico to the United States, or goods being shipped from Mexico to the United States, or going the other way. If there's a likelihood of deferring revenue and or income to a lower tax state, the IRS can come in and say, if you don't have a transfer study to support those deductions, we can disallow those deductions on your return, which becomes a very expensive proposition from the tax standpoint. So as you look to take your activities overseas, whether it's buying a plant in China and figuring out what you're going to be paying for the management services and those types of things between your U.S. company and your related Chinese company or your Mexican company, or wherever you're looking to take that, make sure that you're taking the time to understand that ultimately the IRS and even the Mexican government or the Chinese government may look to see if you're properly charging to make sure that you're not skirting the tax laws between related parties. Hopefully that gives you some insight as to some issues you might be addressing if you take your company global and your products global. If you need more information about transfer pricing, R&D credits, and or IC discs, feel free to give us a call. Thank you.